So for some reason the start of my video cut out, but welcome back to another video, and we're going to be looking at Palantir. We're going to be looking at Palantir, ticker symbol PLTR, the software and data company that recently turned public. The stock's been flying, and early buyers of the stock enjoyed a 200% return over the past month. So today we're going to find out if Palantir is still a good investment at the current stock price. To do this, we're going to have to do the following. First of all, try to understand the business and its operations. If we can't do this, there's no point thinking about the next steps. Second, produce a reasonable growth story for Palantir and its addressable market. 3, align that story with the numbers and our KPIs. Create a financial model. 5, calculate the intrinsic valuation for the company based off of our financial model. So, who is Palantir, or who are Palantir? So they're co-founded by Peter Thiel, current CEO Alex Karp, and others back in 2003. They're headquartered in Denver, Colorado, after moving from Silicon Valley this year. They've adopted techniques they learned whilst working together at PayPal to create an innovative software company which serves both government and commercial customers. So what does Palantir do? In Palantir's own words, they build software that lets organizations integrate their data, their decisions, and their operations into one platform. Their software empowers entire organizations to answer complex questions quickly by bringing the right data to the people who need it. At the core of it, they're a software company specializing in big data integration and interpretation. So their three main products, or their three only products, Palantir Gotham is mainly referred to as government, used for search and discovery, knowledge management, and secure collaboration. Their estimated total addressable market for this is $63 billion. Palantir Foundry, the commercial product, which is used for finding trends in big data sets and providing predictive analysis. Estimated total addressable market is $56 billion. And Palantir Apollo, which sort of ties the Gotham and Foundry together. It's a continuous operating delivery system that manages and deploys both Gotham and Foundry. It orchestrates updates to configuration and software, and since its introduction has improved overall margins by allowing Palantir to offer software as a service, or SaaS, instead of having to adopt a consultancy model, which would be high margin. Palantir actually refer to Apollo or their SaaS as their moat and competitive advantage, but it's sort of hard to find any competition or anyone that does what they do. But still, it does seem to be a unique selling point now that they have Palantir Apollo. Palantir's core aim. So we're going to listen to a clip from the CEO now, where he talks about what his vision is for Palantir, or what Palantir's vision is, and what they're focused on into the future. And he gives us an idea into where he thinks the company's going.
So walk us through what the path to profitability looks like.
Well, we build these products years before people build them, and that takes money. And what you see in the COVID pandemic crisis is we had built this way of going to market with Foundry, which would allow us to literally supply an enterprise with a completely new stack of products within 6 hours and maintain them. And what you saw when we did that is we grew the company 49%. 49% off of a 743 base. And the divergence between expenses and growth is dramatic. And we're just going to be very, very focused on invigorating our software offering. But when you're growing 49% off of a 740 base, I think that's a pretty strong indication of what the future could hold. And we're super proud of that. And I think you're seeing that people are taking a look at our financials, and our company has often been viewed as complex and needing explanation, both moral and financial. But it turns out our financials are quite simple. And you look at this dramatic growth with flatlining expenses, and I think that gives investors comfort. And it certainly makes me feel, as co-founder and CEO, that we made the right decision to invest heavily well over a decade in building software the way other people don't build it, and you see the results. What I can tell you is we are very, very focused on building software a long time before other people building it, supplying it, and I think that our first half of the year growth will be reflective of the future. And if I'm right, that will answer all of your interesting questions, and we'll see how we do. I'm
Right.
quite confident we'll do well. I think what the investors are seeing is they're asking the question at this point. They used to ask, is this a company that builds software for the government, and how do they build it? Of course, we always sold this as a license. Then they saw our margins in the first half of the year around 80%. So I think the real debate now has moved significantly away from, is this software, is this services? Because although people think we're very smart, we're not smart enough to get 80% margins off of a services company. The question then is, how do you comp it? And honestly, I think that's something investors will have to figure out. We're not focused on that. We're focused on, we are going to be the most important software company in the world, and people will figure out what that's valued over a long period of time. And we're very comfortable with investors toying around. It could be like this, it could be like that. We are going to deliver the world's best software with the world's most efficient way of delivering it. Investors will decide what's that is worth to them. And I think you'll find in a number of years that there will be a consensus. Palantir is a truly special software company that is arguably the most important software company in the world.
Okay, so interesting clip there. He obviously, what we can take from it as investors is that he's very much, or Palantir are very much focused on growth. They just want to grow top line, get bigger, get more customers. Similar to Jeff Bezos in a way. They're more focused on a long-term vision rather than marginal finances in the short term. They're keen to focus more on their product and services than they are around margins, which is good. I think we should. That's good. I like seeing that in a company, especially a company of this size and with potential that they have, with the potential that Palantir has. I want to see them focus on capturing more of their total addressable market and growing, and then they can think about the margins later down the line. Accomplishments to date. What's the hype? So three quite notable accomplishments here. We've got, they played a role in locating and catching Osama bin Laden. They also helped uncover Bernie Madoff's Ponzi scheme. They also detected Chinese spyware on the Dalai Lama's computer. So that gives you a little bit of an insight into why they've had so much publicity around them and so much hype if they're achieving things like that. Target market. So their target market is state government organisations, large corporations as well. So they define their target market as the 6,000 companies with more than 500 million in total revenue. They estimate their total addressable market to be $120 billion. So there's definitely advantages to this. One is that they tend to have deep pockets, or the customers will tend to have deep pockets and big budgets for security and defence related spending, which Palantir offers a product or service for. The disadvantages of this is that there isn't too many of them, so there's a concentration risk. If a few of their top customers decide to cut ties with them, i.e. the US government, it will likely be felt in the numbers, and you can't say the same for products that appeal to the masses. Customers, so following on from target market a bit, they're well known for their lucrative contracts with the CIA, Department of Defense, and US Immigrations and Customs Unit. They've been utilised by various US government agencies, but they also have branched out with Foundry to commercial customers. So a few of their commercial customers include JP Morgan Chase to spot rogue employees, Fiat Chrysler to spot faults in car parts, Airbus offering fast response to manufacturing issues, especially on the A350 aircraft, BP to analyse drilling data. So all of these appointments were and are still reporting successful results, which is good. So I've come up with a growth story or narrative, a reasonable growth story of where I think Palantir can go in the next years. So I think it's reasonable that Palantir can achieve strong top and bottom line growth given these factors. Its vast superiority over competitors in producing innovative software and data solutions for their target market. Their relatively small capture of their total addressable market in terms of customer base and total sales. Current 150 customers versus a target of 6,000 and 750 million in sales versus 120 billion total addressable market. Its high customer retention rates and SaaS model, which produces recurring revenues through annual contract payments. This provides Palantir with a solid base for compound growth. It's yet to produce positive EBIT margin due to large investments in R&D, product development and stock-based compensation. These are obviously, I mean, the only thing that's a one-off expense is stock-based compensation. The other two are more early phase, growth phase company expenses that will begin to phase out as they start to mature and as we start to get a little bit further down the timeline. So they will likely produce high margins in the future, provided their business model and demand for products stay the same. Potential to reach an even larger total addressable market by creating software that is more suitable to a less large commercial customer, i.e. 500 million in revenue to 5 billion. I don't think, and as they say it in their target market, they're never really going to be suitable to SME, but it seems as though most of their customers are sort of 20 billion and above, sort of like mega companies, very large institutions. Some going concerns, and there are some. It's hard to argue against the compelling growth story, really. But any of their top 25 customers cutting ties and non-renewing their contracts will very much be felt in the numbers, given their heavy reliance on top quartile customer base. So this is a real issue. Like we said, we had a concentration issue. I don't know whether this will ever not be an issue because of the way that they scope their total addressable market and the type of product they have. However, it is a going concern. They're burning money on stock-based compensation and executive salaries at a time where there's pressure on profit margins. This is obviously a little bit annoying, but do I think it's going to affect their long runway for growth? No, I don't. Controversial work causing protests. Again, this was an issue. A lot of their work with the Immigrations and Customs Unit did spark a lot of protests, and for fairly good reason as well. However, I don't think it's going to play a role in bringing down their long-term growth trajectory. Competition catching up and the unknown, really these are paired together. We don't know much about this. They're a going concern only because we don't know much about their competition. I couldn't find really anyone that does the same thing as they do, or at least to their level. And the unknown is a little bit because we don't really know exactly what the products do. We do, but we don't know exactly how they work. It's too complex on the face of it, and they don't disclose much of it as well because that's their IP. So there are a few of the going concerns. So now we need to start thinking about valuation and how we're going to translate that growth story and factor in the going concerns into a financial model, so we can start to value Palantir and the company as a whole. So our method of valuation, we're going to create a financial forecast for Palantir by aligning our model with the story and narrative. We'll be focusing on 4 important metrics: revenue growth, EBIT or operating income, free cash flow, and reinvestment cost or CapEx. We will then be applying a relative value exit multiple to the final year EBIT, which will be an enterprise value to EBITDA multiple, to get our terminal value. By looking at industry averages and comparable stocks, we'll be able to do this fairly easily. Discount all the cash flows back to the present day for the intrinsic valuation, and then we're going to calculate an expected rate of return from today's stock price in our IRR calculator based off of the financial model we create. So just before we get into the model and valuation, I thought this was interesting. I thought this would be good to sort of put up and have a discussion around. It's the Bermuda Triangle of valuation. It's Aswath Damodaran done a slide on it in one of his presentations. And it's good to think about these 3 sins really of valuation and how we can mitigate them in our valuation. So bias, probably the hardest factor to consciously mitigate. However, we're going to do our best to conduct a balanced story and factor in all of the going concerns. Complexity, really increased complexity usually leads to more errors in valuation, and the more complex you make your valuation, the more likely it's going to be wrong. We'll be focusing, to mitigate this, we'll be focusing mainly on 4 financial metrics that matter, mentioned in the previous slide. Uncertainty, so all valuations are estimates. They're never certain. Estimates are only good as the forecast that we predict. However, we'll be focusing on what we feel the 3 important KPIs are, key performance indicators, that are going to drive Palantir's future financial success. In my opinion, they are top line growth, revenue per customer, and operating margin. So we've got here a clip that I want to show you from the CFO on the Investor Day conference, having a discussion or talking around the finances of Palantir, the financials. Sort of, he simplifies them a little bit, and also talks about what we can expect from Palantir, what their targets are for margins into the future. And it's very insightful. He's done a bit of the work in terms of our assumptions and projections. He's done a lot of the work for us there. Although we can't take it as concrete, and we do need to sort of see if it's reasonable, or at least, if we think it's doable. But it gives us an idea of what we can expect, and we can work out a base assumption off of that.
And now we just talked about a revenue history, like what's generating that revenue. That revenue comes from two software platforms, Foundry and Gotham. So while it's true in the past that we did custom development work and built bespoke applications, we aren't doing that today. We are exclusively deploying these two software platforms across all of our customers. Our contracts are generally fixed fee. Our customers pay us for the all-in cost to deliver, maintain, and service these platforms, and we continue to do this more and more efficiently as our products have matured and adoption across our customer base has increased. We'll move on to our liquidity position. As we think about cash flow, it is important to understand how our contracting has changed over time. Prior to 2020, we pursued multi-year upfront payments for our contracts. This meant that often customers might pay us for a few years in advance. This resulted in significant growth in customer deposits, and often our cash collections being far greater than revenue in any given year. As we've shifted all our customers onto our platforms, the need for upfront payments has been reduced. As the result of this shift, revenue recognition and cash collections from customers should tie more closely together in future periods. As a result, many customers have already paid for 2020 and prior years, and this helped explain the negative cash flow that we saw in the first half of this year. Our balance sheet is exceptionally strong, and we have limited debt. As of June 30th, 2020, we had $1.5 billion in cash on the balance sheet. We are well positioned to take advantage of a host of opportunities for growth that lie ahead of us in these very uncertain times. When we think about the future visibility of our business, there are a number of factors that provide strong visibility and stability for future revenue growth. The first thing to understand is that a significant portion of our business is in the government sector. The metric we use when looking into the future of government revenue is government deal value. At the end of 2019, we had $1.1 billion in deal value against $350 million in 2019 revenue, which is about 3x the coverage. This number, as of June 30th, was in excess of $1.2 billion and doesn't include over $2.5 billion in IDIQ awards we've been awarded, and really is a pretty conservative view.
Okay, so here he's demonstrating to us the huge potential for growth that they have from existing customers by showing us one of the contracts' full value versus exercised/realized revenue. The extent to which these contracts are exercised will obviously depend on customer demand.
Another area to look at when thinking about the stability of our revenue is our existing customer base. Our existing customer base is really our revenue base, and the expansion of existing customers is the main driver of our revenue base. So for example, last year, more than 90% of our revenue came from customers that generated revenue in the prior calendar year. When we think about expected future revenue, our existing customer contracts, on average, offer an additional 3.5 years of revenue using a dollar-weighted average. And although the large majority of our contracts do include termination for convenience clauses, our customers tend to stay with us. If you look back at 2019, our top 20 customers have been with us on average for 6.6 years. Next, I'll move on to how we size our market. We've calculated our total addressable market to be approximately $120 billion. It's spread roughly equally between our two business segments. In the commercial segment, we're calculating this based on 6,000 of the largest companies in the world, but we're excluding those that are based in China and Russia. There's significant space to grow here, as we're currently penetrating less than 3% of the Global 2000. On the government side, we see similar opportunity for expansion both in the US and abroad. And given the growing instability in the world today, our products will be needed more than ever. In closing, I'd like to walk you through our long-term targets. Note that these numbers are on an adjusted basis and are excluding stock-based compensation. While we're positioned strongly today, we are focused on our long-range target model. This will be gross margin in excess of 85%, contribution margin in excess of 70%, and operating margin in excess of 35%. With that, I'll hand it back to Sean.
Okay, so a lot of good information there. Firstly, he's talking about how they're focused on selling and deploying their product rather than building out new ones, which is the costly part of their business. They can then start to achieve some returns on the investments that they've made with Foundry and Apollo. And then also he demonstrates the potential for huge growth in the existing customer contracts, demonstrating how they are not at their full capacity at all. Next, he talks about the examples of some of the retention rates, which are obviously critical to their success. And then also he talks about what sort of margins we can expect from them in the future. So based off of that, we can come up with some assumptions. So our first assumption is Palantir is going to continue growing top line at 35% for years 1 to 5, then 30% for years 5 to 8, 25% in years 8 to 10, averaging 30% for the period. They're growing 50% now, but growth will probably begin to slow as they grow into their total addressable market. Second assumption, they can produce a positive operating margin by year 3, which they've already got a positive operating margin this year, although very small. It's turned negative from the stock-based compensation in Q3, but as I say, that's a one-off expense. It's not nice to see, but it's a one-off expense. We won't ever see that cost again, really. I don't think so. So they'll have their guidance operating margin of 35% by year 2028 is our assumption. We'll be able to exit our investment at 29 times EBIT, which is the middle ground or average between the industry average for software application and the US market average. So here we're being a little bit conservative and accounting for the fact that the software industry might mature and multiples might go down over time and revert more to the US market average. Next projection, cash on hand grows at 10% annually, accounting for reinvestments and new investments. It's fairly conservative. Cash on hand should grow at a quicker rate than that, given they can do the three things above. However, I'm expecting they'll reinvest a lot of that money for growth and hopefully for new investments. Well, I hope they do anyway. Debt remains flat or growing at rate of inflation. This actually I should take out in the model. I've gone with debt going at 5% growth per year, which is fine considering the factors above. I do think they will probably raise debt as they still see themselves in a growth phase, and they'll probably go to market to raise some money again at some point. And Palantir's total addressable market grows at a rate of the economy, fairly conservative, but the scope of their total addressable market is still quite unknown at the moment. So based off of that, we're going to be producing 3 different scenarios, all based off of the assumptions above being the base case. So we're going to come up with a bear case as well, and we're going to come up with a bullish case, and we'll have the 3 different models there, and we'll be able to look at what the intrinsic value is based off of all those 3 scenarios. We are in our financial model for Palantir. I'm going to try and get through it as quick as possible, so if you need to pause the video and digest some of the numbers at any point, then please do. But first of all, you will see this is our base case model. We have our assumptions that we mentioned here, so I'll go over them very briefly, but we already mentioned them in the previous slides before. So we've got average revenue growth of 30% calculated as so. EBITDA margin, positive EBITDA margin as of year 3, and then scaling up slightly to that target margin of 35% in year 8. Federal tax rate 21%. Sales to cap ratio. Their average, I believe, was 1.87 for that period, but we're going to pick that up in a minute. Sales to cap ratio is going to be important because that's going to tell us how much reinvestment and how much maintenance capex we're going to have to use to produce growth into the future. So it's basically the cost of growing revenues, which is in turn going to give us our free cash flow number, or play a role in giving us our free cash flow number, which we will need to calculate the DCF. Cash growth, cash on hand growth of 10%, as we mentioned before, debt growth of 5%, EV to EBITDA multiple of 29. So what we've done here is taken the average, as you can see, this is an average of this table here, where we've got the software system and application industry and the US market as a whole. We've taken the average of those two numbers. As we mentioned before, we're just being a little bit conservative in saying that the market will mature at some point, and the EV to EBIT multiple will likely drop. Now, it might not, but we're just working that way on this occasion. Increase in shares of 1%, fairly normal for a company that's just gone public to do that over the next 10-year period. I do think they'll go back to market to raise some money at some point. So, as you can see, the cells are blue and black. So all the forecast cells are blue. They're all based off of formulas to do with the key assumptions here on the left that we come up with. So, for example, year 1 revenue growth is key to that assumption there. Year 6 revenue growth keyed to that assumption there. And so on and so forth. So what we'll do is we'll start filling out the historical results. That's all we need to do now. We need to fill in the black cells, which are the hard-coded ones. And once we start filling them in, we will have our completed forecast. And you'll see down here the DCF and IRR calculator start to take shape. I may try and speed up this process when editing, but I'm just going to copy at the moment off of all this stuff that I've got already is off of their results that they publish, SEC filings. The rest I'm going to get off Yahoo Finance, which is fairly accurate as I've checked previously. So I'm just going to copy over and you'll see it all start to take shape. I will probably speed this up as it's going to be a little bit boring watching me copy and paste all of this. Complete 10-year financial forecast on Palantir based on our assumptions and the historical figures here. We now have to apply terminal value based on the relative value exit multiple that we're going to be using. So based on our 29 times average multiple that we've got, the terminal value in 2030 is $171 billion. This is an enterprise value, and we'll have to subtract debt and add back cash like we do here to actually get the market cap. But $171 billion doesn't sound like too much of a stretch for me, considering the compelling story that's behind the company and how quickly they're growing at the moment. So if we look at this table here on the right, this gives us a little bit of an idea of comparable public companies that are still in the growth phase, albeit, but a little bit more mature than Palantir, at least in the public market's eye. And it's good because it gives us really some reasonable estimates to how Palantir could be valued in the future. So we've got Salesforce, 224 billion on 19 billion of revenue, 1 billion of EBIT. Obviously, we're projecting 16 billion of revenue, and we're projecting 5.7 billion of EBIT, so almost 5 times Salesforce. Adobe, 225 billion, 12 billion of revenue, 4 billion of EBIT. PayPal, 250 billion on 18 billion of revenue, 2.6 of EBIT. Snowflake, 84 billion on 400 million of revenue and minus 300 million of EBIT. So it doesn't sound too far of a stretch when you look at what's out there and how the market's pricing them at the moment. Now, another interesting table that I made, which gives you, again, some relative value, idea of relative value. These are some other quite hyped up IPO when the company turned public. Ant Group actually hasn't turned public yet, but we're going to keep it in there. And these are some of the values that they actually went public at, how they were valued. Incomparably, Palantir doesn't seem that cheap when you've got Uber at 82 billion, Facebook at 100, Alibaba at 230 billion, and look at where those companies are now. So buying them at the IPO price or just after that, you still would have made a very, very good return because the story was so compelling and they were able to grow at such a quick rate. So Look at the terminal value over here, calculation, enterprise value, and how we're going to turn that into a market cap to get our share price. So we've got our less the debt plus the cash, 4.6 billion, which we've got there, gives us a market cap of 175 billion in 2030 with a share price of $101 per share. Our DCF calculator here is giving us an intrinsic value of 38 billion. That's the value today. That's based off a 15% required rate of return, 25% margin of safety. Intrinsic value, obviously, we're just taking those cash flows that we're going to receive over the 10-year period from the free cash flow and the terminal value of 171 billion there. So that gives us a buy price of almost 29 billion, which is a bit away from the market cap at the moment. Share price today of $16.70. That's our buy price off the DCF. So if we look at the IRR here, let's look at what sort of return we can get if we bought the stock today at $28. So it's saying 16%. That's based off of the free cash flows that we're going to receive, plus the terminal value here, less the upfront investment we have to make. So we've got our total cash flow column here. And that's given us an IRR of 16%. Obviously, you can see this changes as we drop down the price. So if the price drops down again to 20, we get an IRR of 20%. If it drops down to what our buy price is in the calculator, then we get a return of 23%. So it starts to get a lot more compelling as that price drops. However, $28 per share, although it's crept up a lot, 200% actually in 1 month, 16% is still a market-beating return by 4% or more than 4% actually. So it's still a good return. So I guess you could say in summary that it's still a good buy even at today's price given the forecasts that we've predicted. And remember, this is the base case, so we're going to run a bull case as well. We're going to run a bear case. Probably going to have to do that in a separate video now as I'm conscious of how long this video is getting. But I'll upload it in very quick succession. We'll run through that bull case with a few different assumptions and the bear case with a few different assumptions and see what we come up with. Because, I mean, the bull case is going to be interesting because $171 billion for a company with a story like this, it really seems easily achievable for them in 2030 to be of this size when you compare some of the companies here, these market caps. So look out for that. But if you liked it, found it useful, please leave a like. And then subscribe and you'll get a notification of when I upload the bull and bear case. Thank you for watching. Good luck with your investments.